Hello and good evening. Thanks for joining tonight. Tonight we're going to talk about inheritance tax, and the theme of the webinar is how much do I need? The question arises because if you can answer how much you need, then you know what you can pass on during lifetime or otherwise. An important area to think about. It will affect everybody, and the further ahead you can plan with it, the better. As a quick overview, inheritance tax obviously is a tax on the estate, which includes property, money, and possessions of somebody who has passed away. The standard inheritance tax rate is 40%. It's only charged on the part of your estate, however, that is above the threshold. Okay, so the threshold is currently £325,000. So if your assets are beneath that threshold, no inheritance tax to pay. Also, if you leave your entire estate to your spouse, civil partner, or charity, or community amateur sports club, again, no inheritance tax will arise. In addition, if you are able to give your home away to your children, which includes adopted foster or stepchildren, or your grandchildren, you will benefit from an additional 100,000 to your threshold, taking it to £425,000 tax free. Really important to think about, especially with house prices these days. Quite easily possible to be over the threshold just by virtue of your house, before thinking about any investments or business assets you might have. If you are married or in a civil partnership, your estate is less than your threshold. It is possible for your unused threshold to pass over to your partner's threshold when you die, which means that it's possible to have as much as £850,000 tax-free via inheritance. Okay, so some reliefs and exemptions. Some gifts you give away while you're alive may be taxed after your death. They may also be tax-free. Depending on when you gave the gift, taper relief might mean the inheritance tax charge is less than 40%, and in some instances, zero. Other reliefs are available, such as business relief, which allow some assets to be passed on free of inheritance tax or with a reduced bill. That's an important area that we'll come on to shortly. Thinking about who actually pays the tax, the tax is paid from your estate to pay the tax man. It's done by the person dealing with the estate, typically called the executor, if there is a will in place. Very important to have a will in place. It's last thing you want to think about, but it certainly will save a lot of confusion and stress for your bereaved ones, to have things clearly laid out of how you'd like your assets to be passed on. Your beneficiaries, the people who ultimately inherit your estate, don't typically have to pay tax when they inherit. They may have related tax to pay. The example there is that if you pass on a rental, a buy-to-let, for example, and there's rental income, that will have to be wrapped up into their tax return. People you give gifts to might have to pay inheritance tax, but only if you give away more than your threshold and die within 7 years. Tax planning areas, 3 things I'm going to briefly run through tonight. First is the residential home, the family home. Secondly, if you've got a dental business and cash and investments. The number 1 and number 3 there, so the residential home and cash and investments, you've got to think about the 7-year rule. Looking at the house, the family house, so if you pass your home to your husband, wife, or civil partner when you die, there is no inheritance tax to pay if you do this. If that is not what's stipulated in your will, the family home will count as part of your estate. If you leave your home to your children, and within that includes adopted foster or stepchildren or grandchildren, you will benefit from the extra 100,000 on the threshold. And if you give away your home before you do pass away, there is normally no tax to pay, but that's if you survive another 7 years. So passing on the home while you are still alive is very attractive. Paying 40% on the excess of the nil rate band is certainly very punitive. So how to make that possible? Well, if you want to give it away and you still continue to live in the family home, you will have to meet two requirements, which is paying the rent, so you need to pay market rent and pay your share of the bills. And yeah, and as I said before, you have to live there for 7 years. However, you won't need to pay the rent to the new owners if both of the following apply. Firstly, you only give away part of the property, and secondly, that the new owners also live at the property with you, so you're kind of under one roof. An additional benefit of looking at the family home in this way is that the new owner, so the kids, if the kids are giving it to, or grandkids, they are treated as having acquired the asset at its market value at death, and that will typically be substantially higher than the market value at the date of purchase. And that's great because it means future capital gains tax, you've got a higher base cost, therefore a smaller gain in the future. And this is typically referred to as the capital gains tax uplift on death. So really important to think about that for a number of reasons there. However, as mentioned before, if you die within 7 years of giving away all or part of your property, your home will be treated as a gift, and the 7-year rules apply. What are the 7-year rules? So the 7-year rules basically mean that if you do give your assets away, there will be tax to pay if you kind of fit within these sliding timescales below. Over 7 years, you're okay. 6 to 7 years, 8%, 5 to 6 years, 16%, 4 to 5, 24, 3 to 4, 32, and anything less than 3 years, 40%. So worth thinking about, even if you are, not living more than 3 to 4 years, there is still an 8% tax saving there. So hopefully you'll live more than 7, but it's I suppose the message there, it's never too late to look at this. Okay, so moving on to business relief for inheritance tax. Important area for people who do have a business, so typically a dental business with dental practice. You might not be looking at selling it. It might be that you'd like to work until you retire. Thinking about what happens to that asset in the future. If you do pass away while you still own the business, then it's possible to get 100% business relief if it's an interest in a business or shares in an unlisted company. Most of, I'd say 99% of my clients will fall into that category. It is possible to get 50% business relief if the shares control more than 50% of the voting rights in a listed company. Not very common. However, the common one would be land and buildings or machinery owned by the deceased used in the business they were partner or controlled, or land and building and machinery is used in the business and have a trust that you have rights to benefit from. You can only get relief, again, if the deceased owned the business or assets for at least 2 years. I would hope that would be the case in most situations or scenarios there. However, there is an extra aspect to consider with planning for inheritance tax on the business. As often, it's usually tied up with the question of, well, is it better to sell the business and maximize the value, especially for kids or the beneficiaries are not dentists themselves? Well, how will they run that business, and how do you reflect that within the will? It might be that you're thinking of selling your practice and having the cash available to pass on. There is risk with doing that because cash does not qualify for business relief. So it would be, precarious to think about the timings there, because in one situation you get 100% relief from the business. Whereas if you convert it into cash, that's not exempt. It comes straight within your estate and potentially 40% should you be over your threshold. So that's a really important consideration and dangerous mistake to make. So thought and planning ahead as far as possible is advisable. Next, we'll talk a little bit about trust and inheritance tax. However, I don't intend to go into too much detail and keep it very top level. The reason for that is there are numerous types of trusts, and it would be impossible to talk about them all in the scope of what we're trying to achieve tonight. However, some basic areas we can mention for food for thought is that it is possible to put some of your cash property investments into a trust. And if you do that and you or your spouse or your kids are not able to benefit from that, they cease to be part of your estate for inheritance tax. So the idea is giving them away to people that are not yourself, your spouse, or your kids. The grandkids is the best or immediate person who comes to mind. An example here is setting up a trust for your adult children. So the trust is for the adult children, but the adult children are not able to benefit from that. However, they can use the assets and cash to pay for the grandchildren expenses. An example there is the children's education and the school fees, which is a very common tax planning area. Okay. Next, you can set up a trust right away, so it's possible to do during life for the trust to be live during your lifetime, and it's also equally possible to have it that your will establishes the trust as part of when you die. So the trust arises when you die, therefore the assets are transferred at that point. There are possible capital gains tax consequences if you transfer certain assets into trust in your lifetime, depending on what type of trust you ultimately go for. But if the trust is established in your will, it's very unlikely that the capital gains tax won't arise. So that's a consideration that we look at when thinking about what assets you might have and how to transfer them either to a trust or direct to beneficiaries. Depending on which type of trust you use, the trust itself might have its own ancillary taxes to consider. Certain trusts do have a 10% charge, for example, on income tax that might arise within the trust. That's something that needs to be considered also. Stepping back a second before deciding what trust you would like to use and how it can benefit you, you do need to ask the question about how much do I need for myself to get me through my own expense, quality of life, and then decide what's left, and then you can see what vehicle you'd like to use to pass that on and for what purposes for your beneficiaries ultimately. Inheritance tax is a very nuanced area. It needs to be thought about very, very carefully, along with a lot of legal considerations, along with your will and the possibilities of the trust. So the purpose of tonight's webinar is just to give you key areas that might be relevant to yourself. Should you think that, yeah, I could benefit from having a chat with someone about that, please do get in touch. My details are on this slide here. And I want to thank everybody for joining. So, yeah, thanks very much, and good night.